So what happens if the perfect investment property shows up before you are ready to sell? In this video, I'll be going over what a reverse 1031 exchange is and how it works and when it actually makes sense to use one. A reverse 1031 exchange allows you to buy the replacement property before you sell the old one. Instead of selling first like a normal exchange, you purchase the replacement property upfront. You still get the same tax deferral benefits on capital gains and depreciation recapture. The trade-off is that this strategy requires much more structure and planning. It's not something you casually decide to do after going under contract. Investors use reverse exchanges when timing and competition matters. This usually comes up when the ideal property is available right now, and waiting can mean losing the deal. In competitive markets, investors don't want to risk missing out while trying to sell first. A reverse exchange removes the fear of rushing or settling during the identification window. The big advantage is control and certainty, not speed. A reverse exchange is not for every investor and requires upfront capital. You typically need cash or financing available to buy the replacement property before selling. That alone rules out this strategy for many investors. The structure is also more expensive and complex than a standard exchange. This works best for experienced investors who value certainty more than simplicity. A reverse 1031 exchange requires a special structure called an Exchange Accommodation Titleholder. An Exchange Accommodation Titleholder, often called an EAT, is required to make the exchange valid. The EAT temporarily holds title to either the replacement or the relinquished property. This is what keeps the investor from technically owning both properties at the same time. Without this structure, the exchange would not qualify. In most cases, the replacement property is purchased first and parked with the EAT. When the replacement property is acquired, the investor does not take title directly. Instead, the EAT holds the property temporarily on the investor's behalf. This step allows the IRS rules to be followed while still locking in the deal. From the investor's perspective, the property is secured even though title is parked. The 45-day identification period still applies while in a reverse exchange. Just like a forward exchange, the clock starts ticking. This time, the investor must identify the relinquished property they plan to sell within 45 days. The deadline is strict and works the same way as a standard exchange. And if you have any real estate questions planning an exchange like this, my contact information is in the details below. The relinquished property must be sold within 180 days. The sale of the old property has to close within 180 days of acquiring the replacement. There are no extensions and the delays can kill the exchange. Once the relinquished property sells, the exchange funds are applied properly. This is why having a realistic plan to sell is critical. Once the relinquished property sells, the replacement property is then transferred to the investor. After the sale is complete, title to the replacement property is transferred from the EAT to the investor. At that point, the exchange is completed. From the outside, it looks like a normal ownership transfer. Behind the scenes, the structure is what made the tax deferral possible. A common reverse exchange example is about control, not speed. Imagine an investor finds an off-market commercial property they don't want to lose. They use a reverse exchange to secure it immediately. Then they sell an existing property later to complete the exchange. This avoids rushed decisions and gives the investor control over timing and outcome. Most reverse exchanges fail because of planning mistakes, not bad deals. Waiting too long to structure exchange is a major issue. Assuming all lenders can handle reverse exchanges is another common mistake. Investors also get into trouble by not planning the sale of their relinquished property early enough. The best practice is to involve a qualified intermediary early and coordinate with your lender and CPA from day one. A reverse 1031 exchange allows investors to buy first and sell later while still deferring taxes. It's ideal when the right property shows up at the wrong time. The strategy offers control and certainty but requires more planning, cash, and professional coordination. When done correctly, it can solve timing problems that a standard exchange can't. And that wraps up this video. Again, if you need assistance with your 1031 exchange, please reach out. My contact information is in the details below.